Now, a couple of numbers for you on the employment front. Since the beginning of September, in the non-financial sector alone, there have been nearly 300,000 job cuts worldwide. Today in the UK, of course, the claimant count, as we mentioned, was up by over 75,000, a lot more than expected. And our next guest says that many layoffs can be avoided and that companies can save big money by minimising the number of jobs they have to trim. Jeff Muscarella is a partner at NPI. He's with us from New York. Jeff, thanks very much indeed for joining us. It's an interesting point of view. You can save money by not trimming as many jobs. Just run us through that.
Absolutely. Basically, companies are under a lot of pressure today to cut costs, as we all know, and managers have been asked to pore over their budgets again and again and again, looking for cost savings. And when they come back time and again and point out that they just don't see any other areas to cut their cost other than people, what we have found in working with clients is quite the opposite, that if you look at some of your key external spend areas, and these are things like telecommunications, transportation, technology, and you really pour through those agreements and your spending in those areas, oftentimes with a fresh set of eyes, a market-based perspective, companies can reduce the spending in those areas by several $1 million a year, and that translates to a lot of jobs.
I guess this is on the basis that if you make cuts in those areas, it's immediate. A job cut doesn't hit the bottom line until whatever period of time, because you've got to pay an upfront cost, right? So a job cut doesn't start improving your bottom line for quite some time. What's the average that it takes?
The average payback on many of these initiatives is 30 to 60 days, on the outside 90, and as you mentioned with job cuts, sometimes the paybacks for those that you're maybe dealing with severance, unemployment, all kinds of hidden costs that don't always get factored in to the equation fairly and accurately on the front end.
Yeah, so you might not get the benefit until sort of 9 months after the fact, right, is what you're saying?
Exactly. Exactly. Whereas with, I was going to say, with a multinational company we worked with recently, we went and looked at a lot of their telecommunications spending, and we were able to reduce that by over $5 million a year. That hit the bottom line pretty quickly. Okay,
but is that message, the trouble is that message actually getting through? I mean, the other thing is that in economic downturns, companies do decide, well, look, it is an opportunity to get rid of dead wood. You know, when we've had a boom, you accumulate staff, you can get a little bloated. So how do you work out the difference between the two?
Well, I think that is an interesting question, and it kind of gets back to how you manage your human capital. Hopefully companies have in place good performance management programs where they're constantly sifting through their folks and obviously retaining the best and maybe finding other opportunities for others. But at NPI, we focus on helping them manage those external costs, and we have just found that 9 times out of 10, if companies are really willing to dig in, eliminate sacred cows, I mean, times are serious now, they need to, that they can find big savings there, and that will allow them to either reduce the size of a layoff or perhaps forego one altogether.
Well, typically, when you go in and look at a company, is there a normal number one area that you can make in savings? You know, is there a typical area where you think, well, you know, you should focus more on that comes up time after time?
Yes, the commodity purchases tend to be pretty standard. It's areas where they're not so standard. Things like technology, transportation, telecommunications, as I mentioned, professional services. Pricing for these goods and services are all over the map. No two companies pay the same, and they change frequently. So it really requires a market depth and expertise in each of those categories to come in and look at agreements, look at rates, terms, conditions, and find, you know, are you in line with world-class practices at that point in time? And
then this is a great time to negotiate on price, right? I mean, you should be able to bargain a lower price for all your goods and services.
Everyone realizes that they're going to have to give in these tough times, and so, you know, many people assume some of these contracts are fixed, and in fact, many of the multi-year agreements that go into place are what they call back-end loaded. In an outsourcing deal, for example, a vendor may assume that they are going to recoup some of the cost on the back end, and they will artificially give you lower rates on the front end. Obviously, if that was 2 or 3 years ago, you may be paying those higher rates now, and so you want to go back and look at the market and see if you should be renegotiating some of those agreements.
Jeff? Interesting stuff. Thank you. Jeff Muscarella, partner at NPI, joining us.